Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, March 7th, 2020, and this is the weekly market update. First of all, I'm doing this a little bit late on Saturday. It's about 8 o'clock, and I have been sick again the last week. So if I cough or clear my throat during this, don't get too aggravated. It's just I've been sick. This is like the second time I've gotten sick in the last month, all this travel that I used to do. So it's not coronavirus, thankfully. It's just I had a head cold before. Now I have a chest cold. I'm coming off that, so just bear with me. So, speaking of the coronavirus, continues to manifest itself on the headlines. I wanted to bring it to your attention. I found a YouTube channel that I thought was excellent. It's called Medcram, and I will put a link to it in the show notes. And it's done by a doctor, and he really goes through and talks about, he does updates, but he does a lot of like really good education. It's not hyped. It's excellent info, and I really recommend it if you're interested in getting the real scoop on how this virus replicates, how it works. Very interesting, very informative. Um, I, I would say that we're like at the epidemic level now on this thing, but I'm starting to lean more towards it's not as far as affecting populations and being as bad as some people were originally thinking. I don't think it's going to be, and I'm going to tell you why. If you look at South Korea, for example, they have been doing an extensive amount of testing. I mean, they are testing anybody they think has it. They're testing everybody that they can. And what we're seeing is the more testing that happens, we identify cases that are mild or the symptoms are not as big of a deal. And then we're saying, well, the total amount of, it's just a math problem, right? The total amount of people is more. The people that are actually succumbing to the disease is whatever number. And the more people that you test and have the virus but don't succumb to it and die, the number of fatalities go down. So they're seeing like a 0.6% fatality rate. And again, the fatalities are mostly people that have, excuse me, that are immune compromised or old people. Now, there have been younger people that have died, but that's mostly who's succumbing to this. Is it spreading? Yes. Are we going to see a lot more cases in the U.S.? Yes. Is it going to scare people? Yes. I mean, I'm seeing YouTube videos where people are fighting over toilet paper at Costco, literally getting in fist fights. I mean, this is goofy. This is peak hysteria. It's mass hysteria. The markets are in mass hysteria because they don't like uncertainty. No one really knows the facts. And you go on Twitter or some of these other things, and people just with all these wild different ideas on how this thing's, going to affect everybody. So my position on this is that this Medcram's pretty good. A lot of the facts we're seeing, if you look at what's really happening, I think that as we come out of the flu season and temperatures and humidity rises in the northern hemisphere, I'm hoping that this will choke off the virus as it does other viruses. We're coming out of the flu and cold season anyways, the next couple weeks. But I do think as we test more people, we're going to find a lot more cases. But I do think, at the end of this thing, it will peter out at some point. At least I hope so. That if it follows, what typically viruses do of this nature, and then we'll know the true numbers at some point. Then we'll have better facts. I mean, I'm already reading that there's people that already have vaccines that are in testing already. So that doesn't mean that this is going to go away, but there's just, it's just the media has, like I said before in previous videos, they have a bias towards hyping things, and especially with the way that this administration, who they can't stand, is supposedly handling it. Everybody's an expert on this. I'm not claiming to be. I'm just looking for the best facts and trying to be as impartial and rational about this as I can. But, markets are going to continue to sell off until the news changes, until we see this thing peak, is my view, because they hate uncertainty. They don't like it, and no one really knows what's happening. But I think, where am I at with the majority of my funds? Cash, gold, and treasuries. and that's working out fine. Yes, I still have a lot of my speculations, and they're getting hammered. But I'm going to talk about one of them later on. But in the oil market, which is really going to take a pasting here over the next couple of weeks, I think. So anyway, that's where we're at. I'll put a link to, like I said, this guy's YouTube channel. He's a doctor. He does a heck of a good job, I think, and you might want to check it out because I think rationality. You have to really think like what's really going to happen here. If you introduce the common flu into a nursing home, you're probably going to have more fatalities than you will have in the general population. Obviously, the same thing with coronavirus. It attacks people, it affects people in different age groups with different pre-existing conditions. It just depends. And I think you have to take that into consideration instead of the blanket, well, there's 300 million people in the U.S., and if 100 million of them get the coronavirus and it's a 3% fatality rate, then 30 million people are going to die. I mean, that's not how you can do it. That's not rational, and that's not how things are calculated in epidemics. So anyway, people can believe what they want, but if you look at the deaths, it's like I said, it's mostly compromised older people. Okay, so people have been asking me in emails and in some comments, when's a good buying opportunity? So I think I'm looking at this volatility index, and you can see since we woke up here in the U.S. and we had this big sell-offs, volatility has really spiked, and I think we're going to want to see the volatility peak and start drifting back down towards 25 or 20. That we would want to see that in conjunction with some news around this virus kind of getting contained. Excuse me. Oh, but that's what I'm looking at. That's one of the things I'm watching. With this kind of volatility, you usually really don't want to step in front of the freight train and be trying to buy things cheap, and trying to catch a falling safe or falling piano. One thing I did want to point out, I'm going to try to go through this video fairly quickly because my frog in my throat, just every more I talk, it makes me cough. We're seeing a spike in credit strains and fear gauging debt. And let's talk about that. Okay. Overall, I think the overall effect on the population won't be as great as some doomsdayers are saying, but I do think the economy is going to be affected. We're seeing, like I showed in last week's video, PMIs in China crashed. We're going to see knock-on effect here in the U.S. and in Europe. It's going to affect companies, their revenues, and their cash flows, and their ability to service their debt. I mean, there's a good percentage of companies, 15, 20%, however you want to look at it, 25% of zombie companies that are just surviving on and making their interest payments. So if their cash flows become constrained because the economy takes a hit due to this virus and it lasts for some period of time, a couple quarters, we could see the beginning of the end of the current debt cycle. Now, I'm not calling it right now, but this is very intriguing. This is the biggest rise in this particular indicator since 2011. Now, my other indicator I like to look at is this ETF, which is the ProShares Short High Yield Fund. This shorts high yield bonds, and you can see it's spiked recently too. Am I ready to buy it? No, but this is constructive. This is a breakout. We saw this happen though last year at the end end of 2018 when we had the 20% decline in the markets, when we had Powell raised rates at the Fed, and we had this kind of decent move. But you see, it made all-time new lows as credit conditions improved and got, well, I don't want to say improved, but credit spreads and high yield debt came down even further as more people piled into it. So we'll have to see how this plays out. This might be a short-term thing, but it may be the beginning of the end of what I think will be an astounding opportunity for those who understand and can read the credit cycle. But we'll have to see. I really don't think that analysts have been taking down their earnings and revenue estimates enough based on what we've seen in other countries with economies. I think that we're going to see a big hit to earnings, obviously in the first quarter, second quarter. Look at some of who's going to take a cruise? Who's flying? There's companies that are banning travel business travel now. This is going to have knock-on effects all the way through the economy. We just don't know how severe yet. And a lot of these companies that are in these different businesses are debt-laden, and they're just, like I said, zombie companies. And once their revenue and cash flow gets constrained, we're going to see who has the ability to keep making their interest payments. This is really ugly, and it's going to get uglier. We had I just want to take this back. We were very positive going into this year on oil. Shale was starting to roll over. The thesis was great. And then this coronavirus thing hit, and it's just been this, total demand shock, if you will. And the price of oil has just, been in a free fall, which you would expect if you shut down the second largest economy, which is China. That's what you would expect to see. And now you're going to see the knock-on effects around the world as this virus moves around the world. And you're going to see economies become more constrained. You are going to, we had this little relief rally that's just technical, and then this basically fallen off a cliff. And then, there was supposed to be the meeting on Friday with OPEC plus Russia, and that didn't go anywhere. They did not agree to cut, and today the Saudis came out and said they're going to flood the market with oil. I've been thinking about it. It's hard to analyze. I think the Russians walked away. It's a geopolitical type situation, and I think one of two things is going on. The Russians now, their economy is a lot stronger, and their balance sheet is a lot stronger since the last oil shock. And they're pissed off that the United States has been trying to block the Nord Stream 2 pipeline, gas pipeline, through the Baltic and into Denmark for Russian gas. And the Russians are currently embroiled in basically almost at a shooting war with the Turks in Syria, which is a NATO ally, by the way. And I think that the Russians are making a gambit here. Why step up with you already had a demand shock? Why step up and help the Saudis? And this is also an opportunity to really stick it to the U.S. and put the final nail in the coffin of the shale companies. I mean, shale production growth was already rolling over before all this happened. That's why we were seeing this move. That's why we were getting excited. We were seeing a breakout. We were saying, okay, well, oil's moving higher. Maybe it gets to 75 in 2020. And then we had this demand shock from coronavirus. And I think the Russians now they're very strategic players. They're chess players. They're not, they don't do things willy-nilly like we do in the U.S. And I think that, the Saudis are a main instigator of what's going on in Syria with a lot of the Sunni organizations, militant organizations that have been fighting the Syrian government, which is a Russian ally. So there's a lot of things in play here. And I think the Saudis, after the Russians walked away, have said, okay, we're going to open up the taps. We're going to put the pain to the Russians now. So I think this thing opens up on Monday. I think you see another spike down. We definitely get into the 30s. I'm thinking if the demand keeps shrinking because of this virus and then this flooding of the oil market, this thing could get to the 20s very easily, high 20s. I'm looking at this thing to get into the low 30s very quickly, $35, $32 a barrel. I mean, it's already oversold, but if they're just going to open the taps and flood the market, it's not good. So, I got some questions about, well, what does this mean for, our picks? Well, I was bullish on offshore oil services because we were seeing a recovery and we were seeing the oil price go up and we were seeing more forward investment decisions being made. We were seeing a recovery in rig rates. I think you can forget about that for the next couple quarters, at least for the rest of this year. And somebody asked me, what do I think about Valaris? You can't invest in these companies now. I mean, they may not survive. Now, short term, in the short to medium term, we're going to have, a crash in oil prices. This is what's going to happen. It's going to sort itself out. I think this is the final nail for shale, though, in the U.S. It was already in decline. These companies, we get down into the 30s, there's nobody going to be drilling any new wells in the 30s, or if we get down to the 20s, and you're just going to see bankruptcies. And that takes us back to this what I was talking about the other day, or just previous to this chart, with high yield debt. A lot of this hundreds of billions of dollars in high yield debt is because of shale and oil companies. We just talked about, shale or revenue being constrained. I mean, what's going to happen? Nobody's going to be putting new money, and the bankers aren't going to come back and give them any more money. Now, longer term, 3 to 5 years from now, we're going to have an oil shortage because we're just going to have no investment in new reserves. But demand's going to increase. Eventually, we get past the coronavirus. Eventually, we get back, to a relative normal of 100 million barrels a day with 1 million barrel, 1.5 million barrels of growth a year, plus our decline rates anywhere from 4 to 6%. That doesn't go away. But in this interim, if you're going to flood the oil market, like I said, these markets are very precarious because if demand's 100 million and you supply 100 million or 101 million barrels, then that marginal barrel sets the price for the other ones. And you're oversupplied. Conversely, if you if demand's 100 million, you can only supply 99 million, then obviously prices go up. You don't need big changes in supply and demand to set the marginal cost or the cost of the marginal barrel. So this is definitely going to have an effect on investments. This is definitely going to have an effect on all the speculations we were talking about. I mean, you can't own oil here right now. We have not seen the bottom. So we were just dealing with a demand shock. Now we're going to pour all this extra supply in. I mean, I don't know how shale survives this. They're going to get crushed on next week. So this is definitely heading into the 30s. I think you get a move real quick down into the mid 35, 32. And if it continues in the demand situation continues to deteriorate because of the economies reacting to coronavirus, I think you might see into the 20s a spike down to the 20s. But it won't stay there long term. It can't. The coronavirus is not the Black Plague. We will get through it, and then we will return to some normalcy, and demand will return. So, but no investment's going to happen, though. That's the problem. And we haven't been investing enough anyways. We've been talking about that in previous videos. So, yeah, black swans are a bitch. They're not good. We got caught by a black swan here. So I'm reevaluating a lot of positions. I'm thinking about selling a lot of stuff at a loss, bad losses, because you just can't. I don't think you can be involved in the offshore oil market. I mean, there's not going to be any investment at $30 oil. It's just not going to happen. People are scared, and that includes people in business. But gold, it kind of likes negative rates, right? We had this big interest. I mean, there's so much news happened this week. I'm having a hard time even talking just because of this cold. But anyways, look at gold. Recovered. Why? It looks like the Feds just panicked. They just went and cut, rates 50% or 50 basis points. They're going to come back probably with another cut here in March. I mean, when this thing finally does roll off, I think I saw an article that the main central banks in the world in the last month have injected like $625 billion in liquidity into the markets, and it's not going to stanch the flow or what's happening. They don't know what else to do, and I think that my prediction or my view or some other people's view that MMT and physical responses, we're already starting to see that. I've seen more this week where various countries are going to have fiscal spending programs to try to stimulate their economies. If you cut interest rates by 50% at the Fed, that doesn't make me want to go take a cruise. Okay? That's not going to make me want to get on a plane and go to China. I think what they're trying to do, though, is make sure there's plenty of liquidity, stabilize the markets. But, if we're going to see this PMIs crashing, business crashing as far as, getting constricted cash flows, I mean, that's what the market's trying to price. How bad is it really going to affect all these companies? I mean, you're not going to be at $175 of earnings for the S&P. I mean, there is a possibility we could have a GFC type situation getting ready to happen here, caused by all this hysteria and all this business just contracting. So they're cutting rates. Now, if this thing comes back and we get, it gets warm and the virus dies off, man, there's going to be a lot of firepower out there for a recovery. But that's down the road. We can't talk about that right now. All we can talk about is that gold likes this. Gold likes negative interest rates, real rates, the inflation rate, or the 10-year Treasury minus the inflation rate. Now we're going to see, we don't know what's going to happen with inflation, right? With supply chains being affected, prices could be going up. That's why people are fighting over toilet paper in the grocery store. They think that they're hoarding. So, difficult to say. That's why I'm saying with the volatility index where it is and so much uncertainty, you just really cannot be trying to call a bottom here. That's what I'm trying to get to. And there's so many things happening now, knock-on effects. The complexity of the world is now showing itself. This machine is so complex, this globalist machine based on debt. The post-World War II neoliberal order is falling apart in front of our eyes because of a virus. And we don't know where it's going to end. But I do know there's going to be tremendous opportunity at some point. One of the things I want to point out that I'm going to get off here because my throat's killing me. This is a chart of gold for the last year. You can see we're up from about 1275 up to 1670. It's about a $400 move. Gold price in the last year is up about 29%. The gold stocks are up 32%. People say, well, that's pretty good. Gold stocks are tracking gold. No. Typically, gold stocks go up 2, 3, or 4 times the amount that gold goes up. So, gold stocks just as measured by the GDX, just tracking the gold price, is not what we expect. It's actually lagging. Gold stocks are lagging. So I think there's an opportunity there. And why? Because, well, when the stock market sells off like it has so violently and the volatility's there, everything gets sold, right? So gold stocks are stocks. And when stocks go down, the stock market goes down, 95% of stocks are going to go down. But I think that if the gold price maintains or goes higher, which I believe it will because of all the nuttiness that you're going to get ready to see from central banks and from governments when they react to this virus and the damage it's doing to economies, I think that as the volatility decreases, people are going to start saying this is going to get noticed, and people are going to say, look, a lot of these gold companies have a lot of leverage to the gold price, and their earnings are going to shoot up. And especially with an oil price collapse, I mean, 50% of a mine's operating costs are in energy. And a lot of these mines run on, diesel generators. They're in remote places. They have a lot of heavy equipment if they're open pit, diesel powered. That's a big cost for them, running all the haul trucks, all this stuff. So this could be tremendous for the earnings of mining companies. So I think that they play catch up at some time. I think that's an opportunity. I still believe uranium is an opportunity. I mean, if you can, like I said last week, if you can catch uranium participation at a discount of 10%, I mean, you got to be in there buying it, right? I mean, they're not going to stop building nuclear reactors because of the coronavirus. So, but people are going to panic and sell what's liquid because they need liquidity. So they'll just sell whatever they can sell. That's why, the gold price got banged the week before last, and then it recovered. Okay, we had a big sell-off. Gold's liquid. They sold it, and it's recovered nicely. And I think we're going to make all new time highs in the gold price this year. I've said that before, even before this coronavirus. And I think we're going to see unprecedented responses from these central banks and from governments. It's coming. And I think that if we come out of this thing, the danger is, I was trading tweets with somebody else that's a pretty smart guy and kind of bouncing ideas about how this ends. And I'm like, okay, well, let's look at it this way. All this liquidity, all this physical spending that we're going to see, this coronavirus eventually peters out, and then you have this big reflation trade in the economies and in these markets. Then you overshoot to the upside. and then you start really having inflation. You know, that thing we talked about that economists cover with that deflating Tyrannosaurus Rex a few months ago, where the cover story was, "Is inflation dead?" or "Inflation is dead." Um, Maybe in the short term it is, but I don't think it is in the medium or long term. So remains to be seen. It's hard to sit and wait. There's not a lot to do right now with the kind of volatility we're seeing. And I think, you know, we're going to see all kinds of wacky stuff here over the next weeks and months. So an opportunity is coming. I don't think it's here yet. I do think you still have an opportunity in some gold stocks that are undervalued, uranium. I'd stay away from a lot of the juniors right now. I just buy physical uranium. It's so cheap. Why even mess around with mining risk and financing risk and dilution? Who needs it? But there's some small pockets of opportunity. But I think the big opportunity to get into some of the things that we like is coming because they're just getting decimated right now. So saying and doing nothing is a decision, and sometimes that's the best thing to do, and that's what I'm doing right now. So that's it for this week, guys. Appreciate it. Appreciate you putting up with my sick voice, and hopefully I'll do a better job next week and won't have this frog in my throat. Thanks a lot for your support, and we'll talk to you next week.